How is it going, mi amigos? This is Jake. Hope you're having a great day. Welcome to my channel, where we talk about creating wealth. By the way, please subscribe and drop a like. Today, we will discuss 3 topics. First is going to be the portfolio update. Second is my plan for getting this portfolio to 100k, and that's going to be my first milestone. And there is a bonus section where I'll talk about bearish call credit spread. So let's jump to our first topic, portfolio update. Based on my last video, I'm up by almost $4,000. So the last video I was at 59,000 and now I'm at almost $63,000. The market was down today, but I'm up by almost 1.5%, and the primary reason is the covered calls that I have. So for this today I have in total 1.5% gains. For the week I'm at 4.31% gain, or $2,500. For the month I'm up by 14.51%. In dollar amount, almost $8,000. For the 3 months I'm up by 58%. 3 months is kind of a little bit tricky because we had the big crash and so that's why you see that 58%. So that particular number doesn't really have much merit. So up by $23,000. For the year I'm up by 17.77%, and in dollar amount it's approximately $9,500, and overall I'm up by 22%, which equates to $11,000. And this account was started in September 14, 2018. So if we take annual year-over-year returns, this would come to approximately 11% year-over-year. So let's move to the second topic for the day, my plans for getting this portfolio to 100k. So as you might have seen by now, the dollar amount that I invested in this account is $51,000. The remaining, so it's almost $11,000 gains that you see. That's why it's 62,000. So when I started the channel, my initial plan was to document this journey because this is not a super small account, but this is by no means a big account. So someone in their 30s, this is what they would have if they even invested kind of like conservatively, right? So it would be a way for them to kind of get educated just by looking at the mistakes and some of the wins that was made in this account. There are 4 ways this account will grow that I envision. The first one is, of course, the organic growth. The stock appreciates in value. So Microsoft, I bought it I think around $160, so it's at $197 today. So that's the organic growth. So that's number 1. And the second one is dividends and the dividend reinvestments, the DRIP. Robinhood, I think 2 months back, they started the DRIP. So DRIP is a dividend reinvestment. That means once you get dividends, you can have the option to get that money that you got as dividend back into buying the stocks. So Robinhood allows both dividend reinvestments and fractional shares. So even if you get, like, let's say $10 dividend from Microsoft, you can buy a small portion of Microsoft. Yeah, so I did get a couple of $100 as dividends, and that was reinvested back into buying Microsoft. So that's why you see this 0.35. So that 0.35 was bought using the dividend. So that's the second way this account will grow. The third way, of course, would be me depositing money into this account, because of course I'll be saving money. So I'll be adding approximately anywhere from $1,000 to $2,000 a month to this account. And the fourth method is selling covered calls. I had covered this topic in a previous video. So what you see on the screen on the right, Microsoft and JP Morgan, both of these are covered calls that are sold. Also, as I mentioned in my previous video, you can roll up your covered call, roll down your covered calls. All those are different technical ways of making money. That is outside the scope of this video, but just know that this is the fourth way that I plan to make money from this account. If you have any questions regarding this covered calls, please let me know in the comments, and I'll make another video in detail. Okay, let's move to our bonus sections. So today I will be explaining a way to make money with limited risk. So if you are familiar with the market, you would know by now that when I say limited risk, by default you should assume that the amount of money that you're going to get from this method is also going to be low. So more risk, more chance of making money; less risk, lower the chance of making the money. So here I'll be explaining a bear credit call spread. So the idea for this trade is bearish. It's going to be a credit. That means you're going to get money from this trade, and it is a call spread. So a bear credit call spread consists of one short call with a lower strike price and one long call with a higher strike price. So by short call, what it means is you sell a call, and long call means you buy a call. So both calls will have the same underlying stock and the expiration date. A bear call is established for a net credit, right? So you are getting money and the profit from either a declining stock price or from the time erosion, or from both. So the profit potential is limited to the net premium received minus the commissions, but Robinhood does not have any commissions. And potential loss is limited if the stock price rises above the strike price of the long call. So when we talk about the maximum profit, the profit potential is limited to the net premium, net credit that you receive. And you realize this profit if the stock price is at or below the strike price of the short call. That means the short call that is sold at expiration, and both calls will expire worthless. And the maximum risk is going to be the difference between the strike prices minus the credit received, right? So that is a long talk. Let's get on with an example. All right, let's use Facebook. First, you come to the options chain page, and then of course you'll see the current share price, $236.50. So first what you do is you sell a short, you short calls. So short calls means selling call, it's the same term. So first I look for the probability ratio of 84%, because that represents 84% standard deviation, one standard deviation, which represents 84% chance of win. So here the closest we have to 84 is 85. So 247.5 strike price is the one what I'm going to sell. And for the buy, for the same date, for the same stock underlying, I'll buy a 250 long call. So the net credit that I'm going to receive in this trade is $33, right? 0.33 times 100, $33. Let me hit continue. I'll say one contract, 0.33, review order. See the collateral as $250. What it means is that in this trade setup, if the trade goes south, that means against what I wish, the maximum loss that I'm going to make is $250. So that's why the collateral is $250 because Rob, if let's say you had $1,000 in your account when you did the setup, Robinhood will keep $250 in case this trade goes south. So look at the risk that you're taking. You're getting $33, right? You're getting $33, but you are risking $250. That means you have a small chance. So first you have to think, we took a probability of 85% in this trade. So there's an 85% chance that you're going to win, you're going to gain $33. That means you get to keep that $33, but there is a 15% chance that the trade can go south and you'll lose $250. See, if you look at that ratio, let's quickly bring a calculator. Let's do 250 divided by 33. So you're almost, I'll round up this to 8. So you're risking kind of 8 times for what you gain. So that is a little bit too much risk. So we will do a different setup. So what we'll do is we'll cancel this particular trade. So you can do this by just going back, clicking so, and let's move on 1 week ahead, further out. Okay, here now let's look for, select cell, look for one standard deviation. Here we have an 84%, that's one standard deviation. So of course you would see it's a higher strike price because it's further out in time. So I'm selling that at 172. And now for the long call, let me buy a higher strike price, which is $252.5. So I'm getting a credit of 35 cents. So again, not good, because you know the difference, 250 and 252, that is $2.5 times 100, $250. Again, I'm risking $250 just to gain $35. So the whole Facebook thing is not good to do this setup today, because this setup works perfectly when the volatility is high. So instead, what do? I go to Google, because so this is how you should do it. So the reason I'm showing all these stocks is because this is how you should do it. You should not just select one random stock and get on with this spread. You have to find a stock which is highly volatile for the day, and that's the way you should do this trade. So let's look at Google options. 26 is too close, so July, again sell, and let me look at 84. Okay, right here. So that's my short call, and let me buy a higher strike price, which here is $5 more, and let me buy that. So here I'm getting a total credit of 95 cents. So times 100, $95. And how much am I risking? I'm risking the difference between 1510 and 1505, which is $5. 5 times 100, $500. So let's quick do the math. So here we are risking $500 and we are gaining $95 approximately. So it's kind of like 20% risk 5 times. This is a much better number than the previous one that you saw, right? And almost always SPY is the best one to do this kind of trade. So let's look at SPY now. So this is one possible trade. This is something which we can do, but let's also look at SPY in the interest of educating ourselves. So SPY options, this of course tracks the S&P 500 index. So let's look at July 2nd. By the way, SPY has multiple expiry dates in a week. You should know that. And sell, let me look at my one standard deviation. I have it here, 324, and let me sell it. Short call, and let me buy. So here you have in increments of $1, which is perfect. Let me do that. So, and here I get a credit of $20. So this we can do a real quick math, right? You don't need a calculator. So $20, and the difference here is $1. So 1 times 100, you're risking $100 and you're gaining $20. So that's kind of like times 5. That means, see, if you see the collateral that you keep is 100, what you get is 20. So that's a times 5. So that's a good setup. Don't be too much worried about you're only getting $20 and you're risking 100. The whole reason we kept this 84% chance of profitability, because one standard deviation it's a sign that there's an 84% chance for you to win that $20. So that's why it's a low risk, low reward, because it's $20 is a low reward setup. By the way, I heard a news today that a young trader unfortunately ended his life because he did a similar trade, and he saw this big loss amount on his screen, and he thought he actually made that loss and ended his life. But that was just how Robinhood shows the numbers on the screen. So most of the trading platform, once the market closes, they will freeze your numbers, so you don't see the numbers changing on your screen. So your overall portfolio value will look the same, and you will see the numbers changing only on next Monday. But Robinhood does not work like that. So when they're adjusting a trade, so for example, right here, right, you're selling something and then you're buying something, right? So sometimes over a Saturday, you'll see that your account is minus 3 to 4 times 100, so almost $32,000. It will show us minus 32,000 over a Saturday, and you'll just get scared. Oh, so it's not really that you lost the money. Robinhood is just adjusting the trade. So please be mindful, know what you're doing when you do this kind of setup. There are plenty of YouTube videos. Watch them, make sure that you know them, and also know how to do this in Robinhood and know how Robinhood settles this. So if you exactly mimic this trade like this, you know the different risks, right? Because see, when you do this trade, Robinhood is already telling you that your maximum loss is 100. So even if you see for a moment that your account is minus $32,400, don't worry, it's just Robinhood is just adjusting and balancing your account. All right, that's all I had for today, folks. Hope you enjoyed this video. If you did, please subscribe and drop a like, and hope you have a wonderful day. Stay safe, stay awesome. Ciao.